Fundamental analysis is a way of looking at the Forex market by analysing economic, social and political forces that may affect the supply and demand of an asset. Now, in other words, fundamental analysis is a way of analysing potential moves of a currency through the strength or weakness of that country's economic outlook. To do this, however, fundamental traders study macroeconomic indicators, data which is published regularly at a particular time by governmental agencies and the private sector. Now, key figures include data releases on the country's labour market, economic growth and trade, as well as sectorial releases such as housing data or retail sales figures. Fundamental traders follow these data releases and news announcements religiously. This is because in order to piece together the bigger picture of a currency's strength, they use this in relation to other countries. More to the point, these events can represent great trading opportunities. Now, after the publication of these indicators, traders will observe the volatility of the market. However, the degree of volatility is really determined depending on the importance of the indicator, which is why it's important to actually understand which indicators are important and what they actually represent. Naturally, data out of the US tends to have the biggest impact on the financial markets, simply because the US is, as we know, the world's biggest economy. Now let's take a closer look in more detail at the economic data releases that matter. Hands down, interest rate announcements play the most important role in moving the prices of currencies in the Forex market. And as institutions that set interest rates, central banks are the great movers of markets. Now, interest rates dictate flows of investment and the supply and demand of a nation's currency, which is exactly why when central banks change interest rates, they cause the Forex market to experience movement and volatility. And in the realm of Forex trading, accurate speculation of central banks' actions can enhance a trader's chances for a successful trade. Now, when central banks change their interest rates, they are also changing the economic environment. So a cut or raise to interest rates is always something traders are on the lookout for. Now, alongside interest rate changes, any drastic changes in a central bank's monetary policy, including a hint or announcement of non-conventional central bank actions like quantitative easing, will likely cause some wild swings in the financial markets, especially the Forex market here. Now, in general, a rate rise will usually cause that economy's currency to strengthen. On the other hand, a rate cut or extreme measures such as asset purchases will cause that economy's currency to usually weaken. Gross domestic product, commonly referred to as GDP, is one of the primary indicators to gauge the health of a country's economy, and it represents the total market value of all goods and services produced in a country during the year. Now, if the GDP figure is growing, it means that country's economy is doing better, and in turn, if it is decreasing or slowing, it means the country itself is making less money and is becoming less competitive. Now, since the GDP figure itself is often considered a lagging indicator, most traders focus on the two reports that are issued in the months before the final GDP figures. That's the advanced report and the preliminary report. Now, importantly here, significant revisions between these reports can cause some significant volatility. Inflation is another prime indicator of the economic state of a country's economy. Now, the Consumer Price Index, or CPI, is probably the most crucial indicator of inflation. It represents the changes in the level of retail prices for a basket of typical goods and services. Now, if the prices for the basic consumer basket is increasing, that means inflation is also increasing. Remember, inflation is tied directly to the purchasing power of a currency. So if the economy develops in normal conditions, the increase in inflation can, and technically should, lead to that country's central bank increasing basic interest rates, which in turn leads to an increase in the attractiveness of a currency. However, in a time when many major central banks are embarking on QE to stimulate the economy, it is not always strictly the case. Employment data is also a major indicator as it reflects the overall health of an economy or business cycle. Now, in order to actually understand how an economy is functioning, it is important to know how many jobs are being created, what percentage of the workforce is actively working, and exactly how many people are claiming unemployment benefits. Now, US non-farm payrolls, the all-important US NFP, is arguably one of the most important data releases published, full stop. In theory, a good beat from the NFP should strengthen the US dollar, unless it is significantly below market view. Trade balance, the producer price index, and other indicators such as the purchasing managers index and industrial production are all important data releases that all measure production and demand. Now, if a country's goods are in high demand, that same country's currency will also be in high demand. The key is to find and interpret key data points in the report that are relevant to the overall currency trend and apply them when initiating a position. Now, the US trade balance is usually closely watched, so let's use that as an example. When considering a long-term position, Forex traders should always review the data of the US trade balance report simultaneously when looking at other important data points, for example, like consumer prices, GDP, and of course, the Federal Reserve rate announcements. Now, short-term investors will consider the trade balance report as it relates to market sentiment, using the report as a reason to either buy or sell a position in the currency. If we take industrial production figures as another example, as with most of the other fundamental indicators, the markets will actually already have perceived consensus, a consensus number before the release, meaning that if the difference is larger or worse than expected, that stock or the bond markets will react in the short term. Sectoral releases such as retail sales and housing data are also important to keep an eye on. Retail sales data is released on a monthly basis and is important to Forex traders as it shows the overall strength of consumer spending and the success of retail stores, as well as consumer demand sentiment, which indicates broad consumer spending patterns and in turn the immediate health or direction of an economy. Housing data, on the other hand, is one of the most important areas that affect the decision to increase, maintain or cut interest rates by a central bank. For example, expectations of an interest rate cut in the UK would require evidence of a slowdown in housing price increases. If you're a trader trading the British pound, you would watch UK housing data and retail sales figures very carefully, as they will help you gain an edge in shaping your trading strategy. In addition to using fundamental indicators as information about a country's economy, remember the value of a currency is also connected to national and international geopolitical events, elections, changes in government trade policies, and political unrest or tension in a region, which can all cause widespread instability in the financial markets. For example, when political tension escalated between Ukraine and Russia earlier this year, the financial markets were hit hard, everything from commodities and Forex to equities. Now, the prices of sensitive commodities like oil and gas are an important fundamental indicator, as high prices can hurt consumer spending and confidence and curtail the activities of certain businesses and, of course, government services. On top of these important economic indicators, the release of company results are a great trading opportunity for fundamental traders, simply because the release date is usually well publicised beforehand and therefore reveals everything from the profitability and the health of the company to management's outlook and potential future dividend payments. Now, whilst not part of a company's earnings report, director dealings can also cause wild swings in a company's share prices. This is because investors often use them to determine whether directors are bullish or bearish about the firm. Make sure you stay up to date on upcoming scheduled economic data releases and news events and company announcements by watching LCG's Week Ahead, which is every Friday. It keeps you in the know about the financial markets.